Hi everyone, we are from Group B4. Our presentation title is Valuation and Sensitivity Analysis of KLCI Options. So this is our group member. Next, we will move to the first part, which is data selections and parameter estimation. For this assignment, we selected the FBN KLCI European Put Option or KLI from Bursa Malaysia, observed on 25 May 2026. The underlying FBM KLCI level was 1,686 and 50 cents, while the option has a strike price of 1,680 and expires in September 2026. A put option was selected because the FBN KLCI showed a relatively weak market trend during the observation period, making it suitable for analyzing downside market risk. In addition, multiple September 2026 put option strike price were available, allowing implied volatility and volatility skew analysis. The selected option is also approximately at the money, as the strike price of 1,680 is very close to the underlying price of 1,686 and 50 cents. At the money options are commonly used because they provide more reliable implied volatility estimates and meaningful risks for sensitivity analysis. Therefore, the selected option is suitable for Black-Scholes valuations and subsequent sensitivity analysis. Next, we estimate the parameters required for the Black-Scholes model. The risk-free rate of 2.96% was obtained from the 3 to 6 month Malaysia Treasury bill, as its maturity closely matches the remaining life of the selected option. The dividend yield of 3.063% was calculated using the arithmetic mean of 12-month FTSE Bursa Malaysia Composite Index dividend yield observations from May 2025 to April 2026. Historical volatility was estimated at 13.40% using approximately 19 days of FBM KLCI historical price data. Daily logarithmic returns were calculated and analyzed to obtain the volatility estimate. These parameters serve as the key inputs for the Black-Scholes valuation model used in this study.
Now, we will move to the part 2, which is the theoretical valuation. For the theoretical valuation, we apply the Black-Scholes models to price the selected put options. By using the input parameter determined earlier, we get a theoretical put option price of 49.86 ringgit. We then compare this theoretical value with the observed market price of 22.4 ringgit. The comparison reveals a difference of 27.46 ringgit, indicating that the Black-Scholes models values the option significantly higher than the market. The primary reason for this discrepancy is the difference in volatility assumption. Our theoretical valuation used a historical volatility of 13.4%, which is based on past FBN KLCI movements and may not fully reflect the future uncertainty. In addition, market prices are forward-looking and incorporate investor expectation of future market condition. If investors expect relatively stable market condition until expiration, the option premium will be lower than the theoretical value. Finally, the Black-Scholes models relies on simplifying assumptions such as constant volatility and frictionless market. In reality, factors such as market sentiment, liquidity condition, and trading activity can also influence option prices. Therefore, while the Black-Scholes models provides a useful theoretical benchmark, actual market prices may deviate due to the real-world factors that is not captured by the model.
Next, we move to implied volatility and price simulation. Our historical volatility is 13.4%, giving a theoretical Black-Scholes book price of RM49.86. However, the actual Bursa Malaysia settlement price is significantly lower at RM32.4. To analyze this clear pricing gap, we inverted the Black-Scholes formula using Excel solver to back-solve for the market's implied volatility. Using Excel solver, we set our target Black-Scholes book price to match the market price RM32.4, changing the volatility cell. Solver then iterated through the model to isolate the Excel implied volatility embedded in the market price. This yielded an implied volatility of 6.41%. This value is a 6.99% discount relative to historical volatility. We attribute this gap to two factors. First, low liquidity in long-dated OKLI options, which leads to conservative settlement pricing. And second, institutional expectations of a quiet market. Ultimately, this 6.41% represents the market's true forward-looking risk.
After obtaining the implied volatility, we forecast the future FBM KLCI level at maturity using both the log-normal model and Monte Carlo simulation. The log-normal model estimates an expected FBM KLCI level of 1727.14, while the Monte Carlo simulations give a similar value of 1725.89 based on 5,000 simulations. The formula shown below the simulation model was used to generate the 5,000 simulation path, while the table at the bottom right shows the first 15 simulated values. The close agreement between the two methods indicates that the simulation is consistent with the theoretical model. Overall, the FBM KLCI is expected to be around 1726 at maturity, slightly higher than the current level of 1686.5, suggesting a modest positive market outlook. Next, we determine the likely range of FBM KLCI values at maturity. The log normal model produces a 95% confidence interval of approximately 1602 to 1859, while the Monte Carlo simulations give a very similar range of 1607 to 1858. The similarity between the two intervals increases our confidence in the results. In summary, while the expected FBM KLCI level is around 1726, we are 95% confident that it will fall between approximately 1600 and 1860 at maturity, indicating relatively stable market expectations.
Moving on to the sensitivity analysis. First, let's look at the put delta. The value is negative 0.46163. Delta measures how much the option price changes when the underlying index, which is the KLCI, changes by 1 point. The negative value indicates the bearish nature of a put option. Specifically, for every 1 point increase in the KLCI, the put option value decreases by approximately 0.46163 ringgit. Next, we have put gamma, which is positive 0.0029. Gamma measures the rate of change of delta with respect to movements in the underlying index. Since gamma is positive, delta becomes more negative as the KLCI declines and the put option moves further into the money. This means the put option becomes increasingly sensitive to downward market movements, allowing profits to accumulate at faster rate when the market continues to fall. Next, the daily put theta is negative 0.2038. Theta represents time decay. This means the put option loses about 0.2038 ringgit per day simply due to the passage of time. As the expiration date approaches, the option's time value decreases, causing its premium to decline.
Moving on to the remaining sensitivities, Vega measures how the put option price responds to changes in market volatility. Based on the calculation, put Vega is positive at 3.9279. This means that for every 1% increase in volatility, the put option price increases by approximately 3.9279 points. This is because higher volatility increases the possibility of larger movements in the index, which makes the put option more valuable. Next, put rho is negative 2.9051, which shows the sensitivity of the option price to changes in the risk-free rate. Since the value is negative, a 1% increase in the risk-free rate will decrease the put option price by around 2.9051 points. This happens because a higher interest rate lowers the present value of the expected exercise payoff. Lastly, put psi is positive at 2.7302. This means that when the dividend yield increases by 1%, the put option price increases by approximately 2.7302 points. A higher dividend yield lowers the expected future index level, which benefits put option holders because put option become more valuable when the underlying index is expected to fall.
Next, we will move on to the part 5, which is the advanced topic. The Black-Scholes model assumes volatility is constant, meaning every strike price should have the same implied volatility, resulting in a flat line. However, actual market observations tell a different story. As we see here, implied volatility actually increases alongside the strike price, creating an upward sloping volatility skew. This immediately highlights the gap between the model's theory and real-world behavior. On this final slide, we can see a clear contradiction which proves that the equal sign in theory becomes a less than sign in reality. Because implied volatility rises with the strike price, using a single constant number would lead to a mispriced option. Ultimately, while Black-Scholes is a vital foundation, this skew shows why trader must use dynamic volatility surfaces to reflect the true demand and risk of the actual market. Thank you, Doctor, for listening.